Imagine finding a hidden stream of money flowing right back into your farm just by knowing the right paths to follow. What if unlocking significant tax savings wasn't really about super complicated accounting, but more about understanding a few key instructions?
Exactly.
Well, you've landed in the right spot. Welcome to the deep dive.
Glad to be here.
Today, we're cutting straight to it. No fluff. Our mission: to pull out the most powerful, the most impactful tax-saving nuggets from the 2024 instructions for Schedule F. That's the IRS form specifically for farmers.
And we're not just reading it to you. We're going to break down why these details matter to your bottom line.
Right.
Get ready for some, practical insights, maybe some surprising opportunities, and definitely some clarity on keeping more of your hard-earned cash.
Okay, let's do it. Let's start with the foundation. Schedule F itself. What exactly is this form and who absolutely needs to file it?
Right. So Schedule F, Form 1040, profit or loss from farming. It's basically the main IRS form where you report all your farm income and all your farm
A
expenses.
central hub, sort of?
Exactly. It's where everything comes together. If you're a farmer, a rancher, even certain estates or trusts involved in farming or some partnerships, this form is, well, it's essential. It's part of your annual tax filing.
And it gets filed along with your main tax return, like the 1040.
Yep. Right along with your Form 1040 or 1040 SR for seniors, or, whatever main return applies to your farm's structure, like a trust or partnership return. It gives the IRS that snapshot of your farm's financial activity for the year.
Okay, that's the federal side. But it's always good to remember farming involves more than just federal taxes.
Oh, absolutely. And that's a really important point. Well, today we're zeroing in on the federal Schedule F instructions because that's where a lot of the big saving strategies are. You definitely need to keep state and local rules in mind.
Like state income tax, licenses.
It's exactly. State income taxes, local property taxes, various business licenses, depending on what you farm, maybe specific fees. It varies a lot by location, so always check your state and local requirements.
Yeah.
But yeah, today we're focused on maximizing those federal benefits via Schedule F.
Got it. So focusing on federal, what's new or noteworthy for 2024 in these instructions? I know the mileage rate often changes.
You did again, yeah. And it's deceptively simple, but really adds up. The business standard mileage rate for 2024 is up to 67 cents a mile.
67 cents.
Yep. And think about all the driving involved in farming. Checking fields, going to town for supplies, parts runs, farmers markets. Every mile counts. Using the standard rate can be way easier than tracking every single gas receipt and repair bill.
Definitely simpler. So that's a direct deduction opportunity right there. What else is new? You mentioned something about NOLs, net operating losses.
Right. There's a procedural change.
Yep.
They've introduced a new form, Form 172. It's called net operating losses and NOLs for individuals, estates, and trusts.
Okay, Form 172.
It basically replaces some older schedules used for figuring out NOLs, so it kind of consolidates things. It might seem minor, just a form change, but knowing about it is key because it's the gateway to managing farm losses. And as we'll get into, farm NOLs have some really unique advantages.
Okay, good heads up on that new form. So we have the form itself, some updates. Now let's talk about a really fundamental choice: the accounting method. Cash versus accrual. What's the basic difference and why is this a big deal for farmers?
This is a huge strategic decision. The core difference is pretty straightforward, but the implications are big. Cash method means you report income when you actually get the money, and you deduct expenses when you actually pay them.
Money in, money out, like balancing a checkbook.
Pretty much, yeah. Accrual method, on the other hand, you report income when you earn it, even if the check hasn't arrived yet, and you deduct expenses when you incur them, even if you haven't paid the bill. It's more about matching income and expenses to the period they relate to.
Okay, accrual sounds maybe more complex, tracking receivables and payables.
It generally is, yeah. But here's the kicker, especially for farmers. There's a significant advantage for what the IRS calls small business taxpayers.
Ah, the small business taxpayer definition. This lets most farmers use the simpler cash method.
Exactly. This came in a few years back, post-2017 tax changes.
Yeah.
Many small business taxpayers can now choose the cash method. And for this purpose, a small business taxpayer is defined as having average annual gross receipts of $30 million or less over the 3 prior tax years.
$30 million. That's up from last year, right?
It is, yeah. Its index for inflation went up from $29 million. So that threshold covers the vast majority of farms in the U.S., and you also can't be a designated tax shelter.
So if you're under that $30 million average and not a tax shelter, you likely get to choose the cash method. What does that actually mean for managing taxes day to day? Give us a practical example.
The flexibility is huge. Let's say you use the cash method. It's nearing the end of 2024, and you had a really good year, maybe worried about jumping into a higher tax bracket. You could strategically prepay some big expenses for 2025, like buy your fertilizer or feed for next spring before December 31st. Boom, you pull those deductions into your higher income 2024, lowering that year's tax bill.
Ah, accelerating deductions.
Exactly. Or conversely, if 2024 was maybe a bit lean and you expect 2025 to be better, you might hold off on sending out some invoices until January. Delay the income receipt into the next year.
So you can kind of smooth things out between years.
Precisely. It gives you more control over the timing, which helps manage cash flow and potentially avoid those big tax spikes.
That makes sense. But you mentioned a caution about farming syndicates. They generally can't use cash method.
Right, that's an important exception. Farming syndicates typically must use the accrual method. Think of these as more like investment vehicles where outside investors put money in but don't actively run the farm.
All right.
Specifically, the IRS defines it based on how interests were sold if they required registration, or if more than 35% of the losses go to limited partners or limited entrepreneurs.
Limited partners being investors not actively involved.
Yeah, people whose liability is limited
No.
and who don't actively participate in management. So if your structure fits that syndicate definition, that cash method flexibility generally doesn't apply, you're stuck with accrual.
Okay, good distinction. So that covers the basics of reporting and timing. Now let's get into the really exciting stuff, powerful tax strategies, the deductions that can seriously reshape your tax bill, and the big one that jumps out first is the Qualified Business Income Deduction, QBI.
Oh yeah, Section 199A, this has been a huge benefit since it came in. The QBI deduction lets eligible business owners, and that includes almost all farmers, deduct up to 20% of their qualified business income.
20%, that's substantial.
It really is, and what makes it even better is how you take it. It's what they call an above-the-line deduction,
Meaning?
meaning it reduces your adjusted gross income before you even think about your standard or itemized deductions. So it lowers your overall taxable income right off the bat, potentially giving you a bigger bang for your buck than deductions taken later.
So it stacks on top of other deductions. It's not an either situation.
Exactly. You get this in addition to your other personal deductions.
And for farmers, especially those involved with cooperatives, there are some unique wrinkles here that can be really beneficial, right?
Yes, this is a really interesting angle for co-op members. Distributions you get from an agricultural or horticultural cooperative, like patronage dividends or per unit retains shown on your Form 1099 PATR. If they're qualified payments, they count towards your QBI.
Okay, so the money you get back from the co-op can qualify.
Right. But here's the really cool part. If the cooperative itself calculates a special deduction, called the Section 199 AD deduction, and passes that through to you as a patron, also on that Form 1099 PAPR, that amount is also included in calculating your personal QBI deduction.
Wow, so being in a co-op can directly increase your personal QBI deduction.
Effectively, yes. It's like the co-op's tax benefit flows through and adds to yours. It's a direct tax advantage tied to that cooperative structure, kind of an incentive to participate.
That's a powerful incentive. Now, with a deduction this good, there must be some limits, right? It's not always a straight 20%.
Correct. It's definitely valuable, but there are limitations. The actual deduction can be limited based on a few factors. Your overall taxable income is one. The type of business matters, although most farming qualifies. Then there are potential limits based on the amount of W-2 wages your farm pays.
Okay.
And also based on the unadjusted basis, basically the original cost of qualified property the farm owns, like buildings and equipment.
So the calculation can get complicated depending on your situation.
It can. It depends on your specific numbers. So while the potential is 20%, the actual amount might be less depending on these limitations. Definitely something to work through carefully, maybe with a tax pro to make sure you're maximizing it correctly.
Good advice. Okay, next strategy, managing losses. Farming can be volatile, and sometimes there are losses. Net operating losses, or NOLs. You mentioned earlier that farms have a special advantage here.
Yes, this is a critical difference. For most businesses now, if they have a net operating loss, they generally can only carry it forward to future years. They can't carry it back to prior years anymore.
Okay.
But farming losses are different. They get a special rule. You can still carry a farm NOL back 2 tax years before the loss year.
2 years back. So if you had a loss in 2024, you could apply it against income from 2022 and 2023.
Precisely. And think about what that means. If you paid taxes in those earlier profitable years, Carrying the loss back can generate an immediate tax refund.
Cash back now when you might really need it after a tough year.
Exactly. It's huge for cash flow relief. But there's more flexibility, too. You don't have to carry it back. You can elect to waive the carryback and just carry the farm NOL forward to future profitable years.
So you get to choose which is better for you, immediate refund or future tax savings.
Right. It lets you be strategic. Maybe getting cash back now is crucial. Or maybe you anticipate much higher income in the future, and saving the loss to offset that future income makes more sense. You get to pick the approach that yields the biggest tax benefit for your specific situation. And remember, you'll use that new Form 172 to figure all this out.
That's fantastic flexibility. Okay, another tool for smoothing things out, Schedule J, income averaging. This is another one just for farmers, right? How does it work?
Yes, Schedule J is specifically for farmers and fishermen. It addresses that income volatility we keep talking about. Agriculture income can swing wildly year to year, weather, markets, pests, you name it.
So one year might be a huge boom, the next a bust.
Exactly. And if you have that one massive year, it could push you into a really high tax bracket, taking a huge chunk out of your success. Schedule J helps prevent that.
How? By spreading the income out.
Essentially, yes. It allows you to figure the tax on your current year's farm income, they call it elected farm income, by averaging it over the previous 3 years. You calculate the tax as if that income had been spread evenly over the 4 years, current plus prior 3.
So it smooths out the peaks, keeping you potentially out of those highest tax brackets in the big years.
That's the goal. It can significantly reduce your tax liability in those unusually high income years by preventing that income spike from being taxed all at once at the highest marginal rates. It's a fantastic proactive planning tool for managing the tax impact of farming's inherent ups and downs.
Makes perfect sense. Okay, next up. The business interest expense limitation. This is a rule that affects lots of businesses, but farmers seem to have a couple of ways around it. Interest is a big expense for many farms.
It absolutely is. Land payments, equipment loans, operating lines of credit interest expense is often substantial. And yes, while there's a general limitation on deducting business interest that started a few years back,
Capping how much interest you can deduct each year.
right, potentially forcing you to carry forward the excess. But farmers have key exceptions. First, remember our small business taxpayer under $30 million average gross receipts.
Yeah.
They are completely exempt from this interest limitation. Full stop. They can deduct all their business interest. That covers most farms right there.
Okay, so that's a huge relief for the majority. But what about larger farms or maybe cooperatives? Is there an option for them too?
Yes, there is. Even if you don't qualify as a small business taxpayer, certain farming businesses, and also specified agricultural or horticultural cooperatives, can make an election not to have the limitation apply.
They can choose to opt out.
Exactly. They can elect out. This means they, too, can deduct all their business interest expense currently, which, as you said, is critical for cash flow and profitability when interest is a major cost.
That sounds like a no-brainer. Why wouldn't you elect out if you could? Is there a catch?
Ah, yes. There's always a trade-off in taxes, isn't there? If you make this election to deduct all your interest, there's a consequence for your depreciation deductions.
Okay, what's the link?
If you make this election, any farm property you own that has a recovery period of 10 years or more, think longer-lived assets like buildings, maybe some specialized equipment, fences, it must be depreciated using the alternative depreciation system, or ADS.
And ADS is generally slower depreciation, right? Longer recovery periods.
Typically, yes.
Yeah.
ADS uses the straight line method over longer recovery periods compared to the more accelerated methods often allowed under the main system, MACRS. So the trade-off is deduct all your interest now, but potentially get smaller depreciation deductions spread out over more years for those long-term assets.
So you have to weigh which benefit is greater for your specific situation, the immediate interest deduction, or potentially faster depreciation later.
Precisely. It requires careful consideration of your current debt load, your capital investment plans, and your overall tax picture. It's a strategic choice.
Really highlights how interconnected these tax rules are. Okay, let's shift gears to smart income timing and reporting. Unpredictable events, like weather, often force farmers' hands financially. How does the IRS help smooth those out? Let's start with livestock sales due to weather.
This is a really practical and helpful rule. If you're forced to sell livestock more than you normally would because of drought, flood, or other weather-related conditions, you might be able to postpone reporting the income from those excess sales.
Postpone it. Until when?
You can elect to report the income from those excess sales in the year after the sale occurred.
So if drought forced you to sell extra cattle in 2024, you could potentially report that income on your 2025 return.
Correct. It gives you breathing room in the year the disaster hit.
What are the conditions to qualify for that?
There are a few key things. Your main business has to be farming. The sale has to be solely because of the weather conditions. You can't just be culling the herd for other reasons. And, importantly, your area generally needs to have been declared eligible for federal assistance because of those weather conditions.
Okay. And the benefit is delaying the tax hit.
Exactly. It defers the tax liability, helps with cash flow when you're likely already struggling due to the weather event, and gives you time to plan for including that income in the following year.
Yeah.
It mitigates the immediate financial shock.
Makes sense. And there's something similar for crop insurance proceeds, too.
Yes, parallel concept. Normally, you report crop insurance proceeds, including federal disaster payments, in the year you receive them.
Okay.
However, if you use the cash method and you receive insurance proceeds in 2024 for crop damage that occurred in 2024, you can elect to include those proceeds in income for 2025 instead.
Again, shifting income out of the disaster year.
Right. If you can show that under your normal business practice, you would have included the income from selling those damaged crops in a later year anyway, you can defer the insurance money to match that timing.
What's the catch? Is there one?
The main catch is consistency. If you make this election to defer, you generally have to defer all such crop insurance proceeds you receive in that year from that specific trade or business. You can't pick and choose which payments to defer.
All or nothing for that farm operation.
Pretty much, yeah. It ensures the deferral is applied consistently for that business. But it's another great tool for managing income spikes in difficult years.
Okay, let's talk about Commodity Credit Corporation loans, CCC loans. How are those usually handled for tax purposes, and what's the election farmers have?
Generally, when you get a CCC loan, the loan proceeds themselves are not treated as income right away. It's viewed as a loan. Income is typically recognized later,
Right.
like when you sell the commodity or repay the loan.
So default is no income upfront.
Correct. However, you have an important election. You can choose to treat the CCC loan proceeds as income in the very year you receive them.
Why would you choose to recognize income sooner?
Tax planning flexibility. Maybe you had a low-income year otherwise, and you want to recognize that loan income now to take advantage of lower tax brackets or utilize deductions that might expire. Or perhaps it just simplifies your accounting to treat it as income when the cash comes in.
So it lets you time the income recognition. What happens if you end up forfeiting the loan, meaning the CCC takes the commodity?
Okay, if you forfeit the loan, the full amount of the loan you forfeit is reported as income on Schedule F, line 5B. Now, if you hadn't made that election to treat the loan as income when you received it,
The default treatment.
right, then you also report that forfeited amount on line 5C. Essentially, the income is recognized at the point of forfeiture. But if you did make the election to report the income back when you got the loan,
You already paid tax on it then.
exactly. So in that case, you generally wouldn't report it again on line 5C when you forfeit. It avoids double counting. Again, it's about giving you options for income timing based on your situation.
Got it. Okay, let's switch to commodity futures. This can get tricky. How do you distinguish between hedging, protecting against price risk, and just speculating? And why does it matter for taxes?
This is a critical distinction. If you use futures contracts as a true hedge, meaning you're using them to lock in a price or protect yourself from unfavorable price changes for crops you actually grow or inputs you actually use.
Like insurance against price swings.
Exactly. Then the gain or loss on those hedging contracts is treated as ordinary business income or loss. It goes right on Schedule F, along with your other farm income and expenses.
Okay, part of normal business operation.
Right. But the key here is identification. You need to clearly identify these transactions as hedges in your books and records before the close of the day the hedge was entered into, or very shortly after for some types. You need to specify what risk you're hedging.
And if you don't identify it properly, or if you're just trading futures hoping the price goes your way,
Then it's likely considered speculation. If you're buying or selling futures just hoping to profit from price movements themselves, not directly related to your farming production or needs, that's speculation. And gains or losses from speculation are reported differently.
where do they go?
They usually go on Form 6781, Gains and Losses from Section 1256, Contracts and Straddles. And the tax treatment can be different, often involving capital gain loss rules, which might have limitations on deducting losses against ordinary farm income.
So proper classification is key for getting the right tax treatment, especially for deducting losses.
Absolutely. Hedging losses directly offset farm income on Schedule F. Speculative losses might be capital losses, which are treated differently. So clear record keeping and identification are vital.
Makes sense. Last point on income, rental income and self-employment tax. That phrase, material participation, seems really important
It
here.
is the key phrase. Let's break it down. If you just rent out pasture land for a flat catch fee and you're not involved in the tenant's farming operation,
Pure passive landlord.
right, that rental income typically goes on Schedule E, Part 1. And importantly, it's generally not subject to self-employment tax.
Okay, no SE tax on passive cash rent. But what about crop shares or livestock shares, where you get a portion of the production as rent?
That's where material participation comes in. If you receive rent in the form of crop or livestock shares, and you materially participated in the production or the management of the production on that land.
Meaning you were actively involved, making decisions, doing work.
Exactly. Then that rental income is reported on Schedule F, line 2, and it is subject to self-employment tax because the IRS sees you as being actively involved in the farming business generating that income.
Okay, so active involvement means SE tax. What if you get crop shares but don't materially participate? Maybe you inherited the land, live far away, and just collect the share.
Ah, good scenario. If you receive crop or livestock shares but you do not materially participate, then you report that income on a different form. Form 4835, Farm Rental Income and Expenses. And the crucial point here, income reported on Form 4835 is not subject to self-employment tax.
So understanding your participation level can directly impact whether you pay SE tax on that share rent, which can be a significant amount of tax.
Huge difference. Self-employment tax is over 15% right now. So knowing whether you meet the material participation tests, and the Schedule C instructions have detailed tests like hours worked or decision-making authority, is critical for potentially avoiding that tax on share rents. It's a major planning point.
Definitely worth looking into those tests. Okay, we've hit income timing. Let's dive deep into expense deductions. This is where farmers can really make a difference on their tax bill. And a fundamental concept is capitalizing versus deducting immediately.
This is bedrock stuff for farm accounting. The general rule under Section 263A, the Uniform Capitalization or UNICAP rules, says you generally have to capitalize certain costs related to producing property or acquiring it for resale.
Capitalize meaning add it to the cost of the asset, not deduct it right away.
Exactly. You add direct costs and a share of indirect costs to the asset's basis. You recover that cost over time through depreciation or when you eventually sell the asset. It delays the deduction.
That sounds like it could tie up deductions for a long time. But again, exemptions for farmers, especially our small business taxpayers.
Yes, this is another huge simplification for most farms. If you meet that small business taxpayer definition under $30 million average gross receipts, you are generally exempt from applying these UNICAP rules to plants you produce with pre-productive period of 2 years or less, and also for raising animals.
So for most annual crops and livestock raised for sale, small farmers can just deduct the costs as they incur them: feed, seed, fertilizer.
That's right. They can deduct those expenses immediately in the year paid or incurred, depending on their accounting method. No need to capitalize them into inventory or the cost of the animal and wait to recover them. It vastly simplifies bookkeeping and, more importantly, accelerates deductions.
Massive cash flow benefit and less paperwork.
Huge. It directly reduces your current tax liability.
Okay, but what about things with a longer pre-productive period, like starting an orchard or a vineyard? Takes more than 2 years before you get a harvest.
Good question. For plants with a pre-productive period of more than 2 years, you can make an election to still deduct those pre-productive costs currently, instead of capitalizing them.
Even if you're a larger farm that doesn't qualify for the small business exemption, or
Oh.
even if you are a small business.
Yes, this election is available more broadly. It lets you deduct the costs of raising those plants, fertilizer, water, labor, etc., during those non-productive years, rather than adding them to the plant's basis. There's a specific exception, though. This election generally doesn't apply to the cost of planting or growing citrus or almond groves before the end of the 4th year after planting. They have special rules.
Okay. And if you make this election to deduct currently, what are the strings attached? We talked about the interest expense election having consequences.
Similar situation here. If you elect to deduct these pre-productive expenses, 2 main things happen. First, when you eventually sell those plants, any gain you have will be treated as ordinary income up to the amount of the expenses you previously deducted. It's called recapture.
So you lose potential capital gain treatment on that portion.
Correct. Second, if you make this election, you generally must use the Alternative Depreciation System, ADS, for all property placed in service on your farm during any year the election is in effect.
There's that ABS again, slower depreciation.
Right. So again, it's a trade-off. You get the deduction for the growing costs now, but potentially face ordinary income recapture later, and you're forced into slower depreciation for other farm assets. It needs careful thought.
Definitely. Okay, let's hit some common high-impact deductions, car and truck expenses. We mentioned the standard mileage rate earlier. What's the alternative?
The alternative is deducting your actual expenses. This means keeping track of everything: gas, oil, repairs, tires, insurance, registration fees, licenses, and even depreciation on the vehicle attributable to its business use.
Sounds like a lot more record keeping.
It absolutely is. That's why many farmers prefer the standard mileage rate, 67 cents per mile for 2024. You just need a reliable log of your business miles driven. Way simpler.
When can you use the standard rate? Are there restrictions?
Generally, you can use the standard rate if you own the vehicle and use the standard rate the first year you used it for business.
Yeah.
Or if you lease the vehicle, you generally have to use the standard rate for the entire lease term if you choose it initially. You can't switch back and forth easily on the same vehicle year to year.
And regardless of method, you need to file Form 4562.
Yes, if you claim any vehicle expenses, actual standard mileage, you need to complete Part V of Form 4562, Depreciation and Amortization, detailing the vehicle usage. Good records are key.
Okay. Depreciation and Section 179. This is huge for farms with big investments in equipment and buildings. How do these work?
Depreciation is how you recover the cost of long-lasting assets over time: buildings, machinery, vehicles, breeding livestock, etc. Section 179 is a way to supercharge that deduction.
Supercharge how?
Section 179 lets you elect to expense, meaning deduct immediately a large portion, or even all, of the cost of qualifying new or used property in the year you buy it and place it in service, rather than depreciating it over many years.
What's the limit for 2024?
For 2024, the maximum you can expense under Section 179 is $1,220,000. There are phase-outs if you purchase too much property in a year, but it allows for a very significant upfront deduction.
$1 million plus potentially deducted immediately. That's massive for lowering taxable income.
It is. It's a huge incentive for businesses to invest in equipment. And there's also bonus depreciation, another form of accelerated depreciation, which for 2024 allows you to deduct 60% of the cost of qualifying new and certain used property in the first year. Section 179 is often more flexible, though.
And you mentioned a special rule for certain trees and vines.
Yes. For fruit or nut-bearing trees and vines planted or grafted after September 27, 2017 and before January 1, 2027, there's often a special depreciation allowance, potentially allowing for that immediate 60% bonus depreciation in the year of planting or grafting. Another boost for those long-term investments.
And just to circle back, that election to deduct all your business interest forces you onto the slower ADS depreciation for assets with a 10-plus year life.
Correct. That's the trade-off we discuss. If you elect out of the interest limitation, say goodbye to accelerated depreciation like May CRS or maybe even Section 179 for those longer-lived assets. They must use ADS. It's a critical link to remember.
Okay. Conservation expenses. Deductions for taking care of the land. What qualifies?
This allows deductions for costs to conserve soil and water, prevent erosion, or even help endangered species recovery on your farmland. Think leveling land, grading, terracing, building ditches or ponds, planting windbreaks, even clearing brush.
Things that improve the land's sustainability and productivity.
Exactly. These are considered deductible business expenses.
Is there a limit?
Yes. The deduction is limited to 25% of your gross income from farming for the year. Gross income from farming here excludes gains from selling certain assets like machinery or land used in the business.
25% limit. What if your costs are higher?
Any excess expenses over that 25% limit aren't lost. You can carry them forward to future tax years and deduct them then, still subject to the 25% limit in those future years.
So you eventually get the deduction. Is there a requirement for a plan?
Yes, the expenses generally must be consistent with a conservation plan approved by the Natural Resources Conservation Service, NRCS, of the USDA, or a similar state agency. It has to be part of a recognized conservation effort.
Got it. Prepaid farm supplies and feed. Paying for next year's inputs this year. There are rules around this, right? You mentioned a 50% rule.
Right. If you use the cash method and your prepaid supplies, feed, seed, fertilizer, etc., that you haven't used by year end exceed 50% of your other deductible farm expenses for the year, your deduction for those prepaid supplies might be limited.
Okay, that's a threshold check. But even if you're under 50%, there are other tests.
Yes, 3 key tests must be met to deduct prepaid supplies in the year you pay for them. 1. It has to be an actual purchase, not just a refundable deposit. 2. There must be a valid business purpose for the prepayment, like locking in a price or ensuring supply, not just tax avoidance. And 3. The prepayment deduction can't materially distort your income for the year.
Materially distort, meaning making your income artificially low just because of the prepayment?
Basically, yes. If it significantly skews your income picture solely for tax reasons, the IRS might challenge it.
Yeah.
If you fail any of these tests or exceed the 50% rule without meeting certain exceptions, you have to wait and deduct the cost in the year the supplies are actually used or consumed.
Timing is key, and you need a good business reason.
Exactly.
Business meals and travel. Quick recap on the current rules.
Farm business travel lodging, transportation to conferences, or to check on distant operations generally fully deductible. Business meals, however, are typically only 50% deductible now. That temporary 100% deduction is gone.
50% for meals and entertainment.
Generally, no deduction for entertainment expenses anymore. Taking someone to a ball game, even for business discussions, usually isn't deductible.
Okay, clear enough. Now, let's quickly add some other deductions from line 32 of Schedule F business startup costs.
If you started your farm in 2024, you can elect to deduct up to $5,000 in strata costs immediately. Things like market analysis, initial advertising, training employees before you open. That $5 K limit starts phasing out if your total startup costs exceed $50,000.
And costs above $5,000.
Those remaining costs are amortized, deducted evenly over 180 months, starting when the business begins.
Business use of your home. Farmers often have a home office.
Absolutely deductible if you meet the requirements primarily, using a specific part of your home exclusively and regularly for farm administration or management. You can deduct a portion of utilities, insurance, repairs, property taxes, mortgage interest based on the square footage used. There's also that simplified method, $5 per square foot, up to 300 square feet.
De minimis safe harbor. Sounds complex, but I think it's about small purchases.
Exactly. It lets you just expense small dollar purchases of tangible property immediately, instead of capitalizing and depreciating them. Generally, items costing $2,500 or less per item, if you don't have audited financials, can be expensed under this safe harbor. Saves a ton of depreciation tracking for small tools or office items.
Forestation and reforestation costs.
You can elect to expense up to $10,000 per year, $5,000 if married, filing separately, of qualifying costs for establishing or restoring timber stands, site prep, seedlings, planting. Costs above that can be amortized over 84 months, much faster than normal timber depletion.
Legal and professional fees.
Deductible if directly related to the farming business. Fees for tax prep for the farm, tax advice, legal help with farm contracts or issues, those are deductible on Schedule F.
And finally, taxes. Which ones can you deduct on Schedule F?
You can deduct state and local real estate and personal property taxes on farm business assets, land, buildings, equipment. Also, the employer's share of Social Security and Medicare taxes for farm employees, federal unemployment tax, FUTA, and state unemployment taxes.
What can you not deduct there?
You cannot deduct federal income tax, your self-employment tax itself, though half of it's deductible elsewhere on Schedule 1, estate gift taxes, or taxes for improvements like paving. Those get capitalized. Also, state and local sales taxes on items you buy usually just become part of the cost of the item, not a separate tax deduction on Schedule F, and no deduction for taxes on your personal residence portion.
Good clarification. Okay, we've covered a ton on deductions. Let's move to some special circumstances and compliance points. First, farms owned and operated just by a married couple. This qualified joint venture, or QJV, sounds like a big simplification.
It really is. It's a fantastic option, often overlooked. If a farm is owned and operated only by a married couple, are both spouses materially participate?
Both actively working and managing.
Right. They can elect to be treated as a qualified joint venture instead of a partnership.
What's the big advantage? Avoiding the partnership return.
That's a major one. No need to file the complex Form 1065 partnership return. That saves time, hassle, and potentially accountant fees. But arguably the bigger benefit relates to Social Security.
How so?
With a QJV, each spouse files their own Schedule F, reporting their share of the farm's income and expenses based on their interest. And crucially, each spouse files their own Schedule SE for self-employment tax.
So both spouses build their own Social Security and Medicare earnings records.
Exactly. This ensures both spouses get credit for their work on the farm towards their future retirement and Medicare benefits. If they just filed as a sole proprietorship under one spouse's name, the other spouse might get no credit. QJV fixes that while simplifying the filing. There's also a similar outcome in community property states, where the business might be treated as a sole proprietorship but earnings split for SE tax.
That sounds like a much fairer and simpler approach for married farming partners. Okay, estimated taxes. Most self-employed people dread quarterly payments. Farmers get a break.
A huge break, yes. It acknowledges that farm income is unpredictable. If at least two-thirds of your total gross income for either the current year, 2024, or the prior year, 2023, is from farming or fishing,
Two-thirds threshold.
then you generally don't have to pay quarterly estimated taxes throughout the year to avoid penalties.
No quarterly payments, so what's the deadline?
You just need to file your 2024 tax return and pay all the tax due by March 3, 2025. Normally, the deadline is March 1st, but it shifts if that's a weekend or holiday.
So you get until early March to file and pay everything without penalty.
Correct. It gives you time after the year ends to actually see how the year turned out financially before calculating and paying the tax. Massive flexibility compared to other businesses.
Definitely a big advantage. Okay, finally, let's tackle some crucial loss limitations. At risk, passive activity, and excess business losses. These can stop you from deducting losses you thought you had.
Yes, these are essential guardrails the IRS uses. They basically ensure you can't deduct losses that you aren't truly economically bearing or losses from activities you're not actively involved in. And they apply before you get to your final Schedule F profit or loss number. They have a specific order, too.
Okay, walk us through the order. First up, at-risk rules. What does at-risk mean here?
At-risk rules, Form 61988, basically limit your deductible loss to the amount you personally stand to lose in the farm activity. If you have financing where you're not personally liable non-recourse debt beyond the farm asset securing it, or if you're protected against loss by guarantees or stop-loss agreements, that amount isn't at risk.
So you can only deduct losses up to the amount you've actually invested or are personally liable for.
Pretty much, yeah. It stops deductions based on financing where you have no real skin in the game beyond the specific asset.
Okay, after at-risk, what's next? Passive activity loss rules.
Right. The PLL rules, Form 8582. These kick in if you don't materially participate in the farming activity. We keep coming back to that concept.
So if it's more of an investment for you, not hands-on farming.
Then losses from that activity are generally considered passive losses. And the rule is, passive losses can only offset passive income. You generally can't use passive farm losses to offset income from your active job or your investment portfolio income like interest and dividends.
So passive losses are stuck in their own category unless you have passive income.
Generally, yes, until you dispose of the entire passive activity.
Okay, so first at risk, then passive activity. What's the third filter? Excess business loss limitation.
Yes, this is a newer one, impacting non-corporate taxpayers. There's an overall limit on how much total net business loss you can deduct in a single year. For 2024, if your total business deductions exceed your total business gross income plus the threshold amount.
What's the threshold for 2024?
It's $305,000 for single filers or $610,000 for married filing jointly. If your net business loss across all your businesses exceeds that threshold plus your business income, the excess is disallowed for the current year.
Disallowed completely, or just delayed.
Delayed. The disallowed amount isn't lost forever. It gets treated as a net operating loss, NOL carryover, to the following tax year. So you eventually get the deduction, but it's capped in the year the loss occurs.
So recap the order. At risk first, then passive activity, then excess business loss. You have to apply them sequentially.
Exactly. That stacking order is crucial for calculating the correct deductible loss for the current year and any carryovers. Understanding these limits prevents nasty surprises where you thought you had a big deductible loss, but these rules limit it.
Very important. One last quick point. Conservation Reserve Program, CRP payments, and self-employment tax. There's an exemption.
Yes, a specific one. If you are receiving Social Security retirement or disability benefits, any CRP payments you also receive are exempt from self-employment tax.
So retirees or disabled individuals getting CRP don't pay SE tax on those payments.
Correct. It's a nice break for them. The adjustment isn't made on Schedule F itself, though. You subtract those CRP payments when calculating your net earnings from self-employment on Schedule SE, line 1B.
Okay. Good detail for those specific individuals. Wow, we have really covered a lot of ground here. Diving deep into Schedule F, from the QBI deduction and NOL flexibility to income averaging, smart expense deductions, and navigating those tricky loss limits.
It really shows that understanding these instructions isn't just about compliance. It's about actively managing your farm's financial health. Applying these strategies can genuinely make a difference to your bottom line year after year.
Absolutely. So, as you wrap up your farm year, think about this. You plan meticulously for your crops, your livestock, the weather, every variable you can. Isn't it just as vital to cultivate your tax strategy with that same foresight? To make sure every seed of effort you plant yields the maximum financial harvest, keeping more of what you worked so incredibly hard to grow.
That's the goal. We really hope this deep dive has given you some valuable insights. Review these areas, definitely talk them over with your tax professional, and see how you can turn this knowledge into real, tangible savings for your farm. It can make a huge difference.